What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. Today we're continuing our coverage of the now almost year-long government crackdown on Chinese tech companies. Perhaps the worst hit tech company of this saga has been the ride-hailing company Didi. Within days of them raising $4 billion from their blockbuster IPO on the New York Stock Exchange, the stock price started dropping like a rock as the Chinese government temporarily banned new downloads of their app. The government is becoming increasingly concerned about Chinese tech companies IPOing on US exchanges. When a company lists on a US exchange, they expose themselves to scrutiny from the US securities regulators and may have to disclose sensitive information. Communist Party officials were furious about Didi's New York listing because the company had sensitive data which they may have to disclose to the SEC. After the government temporarily banned Didi's app, it was pretty clear that their status as a US-listed company wasn't sustainable. The uncertainty around the situation caused the stock price to lose more than half its value since the IPO. On December 5th, Didi announced that it would delist its shares from the New York Stock Exchange and relist on the Hong Kong Stock Exchange. The stock immediately tanked almost 25% on the news. It has since recovered some of those losses, but is still down roughly 14%. In this video, we'll explain how the delisting process works, whether the sharp decline in Didi's share price is justified, and what this all means for the future of other Chinese companies listed on US exchanges. Didi is China's largest ride-hailing company by far. You can think of them basically as the Uber of China. In July of 2021, they decided to take advantage of high US stock market valuations to list their shares on the New York Stock Exchange. US investors were quick to fall in love with the company, and they raised $4.4 billion at a valuation of almost $70 billion. But this success didn't last long. Within days, the government banned downloads of Didi's mobile app for alleged national security concerns. This ban remains in effect to this day. But how could a ride-hailing company possibly pose a threat to national security? The concerns were raised by the Cyberspace Administration of China, which is the company's national internet regulator. Since 2018, Didi has been recording in-car audio of passenger trips. The purpose is to increase passenger safety by having recorded evidence if anything out of the ordinary happens during the trip. This means that the company has access to the conversations of everybody who rides in their cars, which could include government officials and other important figures within China. Theoretically, Didi could have to turn over their data from their audio recording to US regulators because they're a US-listed company. This was the ostensible rationale for the government cracking down on them. The SEC is mainly concerned with things like financial fraud, insider trading, and market manipulation. The prospect of the US court compelling Didi to hand over in-car audio data to the SEC seems extremely remote. But for whatever reason, the Chinese government has become extremely concerned about Chinese companies listing on US exchanges. So what does it mean for Didi shareholders now that stock will be delisted? When the delisting happens, Didi will simultaneously make a new listing on the Hong Kong Stock Exchange. There are many Chinese companies with dual listings on the New York and Hong Kong stock exchanges. Alibaba is one such example. When you adjust for currency conversion and the fact that New York listed shares represent 8 ordinary shares, the prices on the two exchanges are almost exactly the same. Whether the stock trades in Hong Kong or New York doesn't really matter. Both exchanges are open, so investors from all over the world can purchase them. The fact that Didi will convert its shares to the Hong Kong exchange shouldn't impact the price. If anything, it's probably a good thing. Once they are removed from the US exchanges, this will likely appease the Chinese regulators, thus making them more likely to allow the company to relaunch their app. So then why did shares fall 25% after the delisting news? According to Reuters, part of this sell-off can be attributed to net selling pressures from individual investors. According to the research firm Vanda Research, retail investors were big net sellers of Didi shares after the delisting was announced. This is after being net buyers on most days over the prior month. According to analyst Giacomo Peritoni, most investors don't understand the delisting process and would prefer to just dump their shares, even if it's for a huge loss. It's likely that many investors erroneously believe that their New York listed shares will become worthless after the delisting. Another possible fear is that many popular retail brokerages such as Robinhood do not support Hong Kong listed shares. So what happens if you own a share of Didi on Robinhood? According to Robinhood's website, when a stock you own is delisted, you'll still be able to sell it, you just won't be able to buy additional shares. So even though Robinhood doesn't support trading of Hong Kong listed stocks, they will still allow you to sell your shares for whatever price it ends up trading at in Hong Kong. And as we explained earlier, there's no reason to believe that the Hong Kong valuations should be materially lower than the New York valuations. It's still the exact same company. This video isn't financial advice, and I'm not saying that Didi is a good investment. They still have a lot of issues with the Chinese regulators. The point I'm trying to make is that the delisting itself is not a bad thing. It probably doesn't make sense for the share price to be down 14% just on this news. There are currently over 200 Chinese companies listed on the New York Stock Exchange and Nasdaq, including household names like e-commerce giant Alibaba, electric vehicle company NIO, and the country's dominant search engine, Baidu. With the Chinese government cracking down on Didi's IPO, there are serious fears that other US-listed Chinese stocks may be next in line. In fact, a broad delisting of all Chinese stocks is very much in the cards. After the Luckin Coffee debacle, then-President Donald Trump signed the Holding Foreign Companies Accountable Act into law. This law states that US-listed companies are required to have their financial audits inspected by the US regulators. Chinese companies do have their financial statements audited by major accounting firms such as KPMG or PwC. But the US regulators essentially want to audit the auditors to make sure that everything is above board. The US regulators already do this for publicly traded companies based in the US and most other countries. However, China does not allow this. They view it as a breach of their sovereignty for a foreign government's regulator to look into the books of Chinese companies, even if these companies are listed overseas. The Holding Foreign Companies Accountable Act has a 3-year grace period before non-compliant companies are delisted. If Biden and Xi can't strike some sort of compromise before 2023, all Chinese companies will probably be delisted from the US exchanges. And with increasing tensions around Taiwan and other issues, the chances of a deal seem pretty remote. For the past 2 decades, China's internet giants have expressed a strong preference to list in the New York as opposed to domestic Chinese exchanges. Part of this is because the American capital markets are perceived as being more developed, making it easier to find buyers for multi-billion-dollar IPOs. Also, founders may want to sell their shares in US dollars. That makes it easier for them to bypass capital controls and take their wealth outside of China. President Xi has been trying to increase development of the country's domestic capital markets. To this end, they just opened up the brand new Beijing Stock Exchange in the past few months. Going forward, the government would prefer Chinese companies to list on domestic exchanges. Because of the country's strict currency controls, most ordinary Chinese investors cannot buy shares listed on foreign exchanges. This means they can't buy shares in Alibaba, which is listed in New York, or Tencent, which is listed in Hong Kong. In fact, not a single one of the Chinese tech giants is accessible to domestic investors. Imagine if America's mega-cap tech stocks like Facebook, Google, and Tesla could only be traded by non-US investors. That's basically what's happening in China, and is likely a major reason the government wants to curb foreign listings. It's very likely that other Chinese companies will be forced to delist from US exchanges over the coming years. In fact, Alibaba, Baidu, and JD.com have all opened dual listings in Hong Kong to prepare for this. When this happens, it's not necessarily a bad thing, because you can still sell your shares on the Hong Kong market. If you own shares of Chinese companies or any other company that faces delisting risk, don't panic sell your shares. Do your own research and consult with a professional to understand the specifics of the delisting process, because it's not always as bad as it seems at first. Alright guys, that wraps it up for this video. What do you think about Didi's delisting? Do you think the 25% sell-off was an overreaction? Let us know your thoughts in the comments section below. As always, thank you so much for watching and we'll see you in the next video. Wall Street Millennial, signing out.